The 2023 recession is probably the most anticipated recession we have ever had. Well, at the time of this video, the recession hasn't happened yet, but you get what I mean. If you tune in any media about economy, getting a recession in the second half of 2023 is always in the topics. From Fed officials to super investors, the severity of a recession seems to be the only difference people do not agree on. Some say it's going to be a hard landing. Others predict it will be a soft landing. So where should you park your money when the next recession comes knocking on the door? Hello friends, today we're going to share an opportunity that could weather the next economic downturn. The answer, believe it or not, is a simple 4-letter ETF. But before we get into all the nitty-gritty details, I'd really appreciate it if you could hit that like button and subscribe for more awesome content like this. Now back to the recession talk. The secret weapon we're going to share today is an ETF called SCHD. If you don't have time finishing the rest of the video, just remember these 4 letters, SCHD. But if you want to know why this ETF can be the key to survive and thrive in the face of economic uncertainty, stay with me till the end. You know, recessions are part of an economic cycle, so they're pretty common to run into every now and then. They usually happen when the Federal Reserve decides to raise interest rates and shrink its balance sheet. And guess what? The Fed has been doing exactly that for a while now. And because people think that the Federal Reserve has been too easy on monetary policy for too long, and that because Fed has been raising the interest rates too quickly, conviction that a recession will hit in the later half of 2023 is very high. In light of this, it's important to figure out the best approach and where to invest before the recession hits. Personally, I think it's wise to look for safe haven stocks and ETFs that have the potential to remain steady the recession starts. In other words, we try not to lose too much money during a stock market downturn fueled by economic recession. When the economic cycle turns the page, or even when the Federal Reserve eases off in interest rate hikes, we might see a new environment where our investors will flourish. Now, let me introduce you to SCHD, the Schwab U.S. Dividend Equity ETF. At time of this video, SCHD is down about 4.6% year-to-date, trading around $72 a share. Over the past 5 years, however, this ETF is up to 41%. On top of that, this ETF has an attractive feature other ETFs can only dream of: the high dividend it pays. With its dividend reinvested, SCHD's return is more than 65% over the last 5 years. SCHD is constantly paying investors generous dividends regularly, regardless of the market going up, crashing down, or moving sideways. This makes SCHD more attractive in current environment because buying it when its price is off the highs is like picking up a treasure at bargain price. If you were to invest in SCHD at this point, you could potentially lock in a very attractive long-term yield on cost. Plus, there's a good chance that SCHD will increase its dividends further in the upcoming years. So not only would you be getting a solid starting yield, but you might also see those dividends rise over time. It's definitely something worth considering for investors who are looking for stability and a good return in the long run. The main reason why SCHD is able to pass along handsome dividend is because of its holdings. Take a look at the diversified basket of stocks that SCHD has. This ETF tracks the Dow Jones U.S. Dividend 100 Index, which consists of highly defensive companies that tend to perform well in almost any market conditions. These companies share a common trait: they consistently pay and grow their dividends over the long term. The dividend is like another layer of protection for investors. Even if the price of this ETF drops, investors can still get rewarded regularly on the dividend payout. In a recessionary environment, especially for conservative long-term dividend growth investors, it's crucial to have a portfolio that offers a sense of security. Over the past 10+ years, SCHD has shown a remarkably consistent dividend growth rate. That kind of stability is attractive for any investor, whether you're facing a recession or not. It's comforting to know that the ETF has a proven track record of delivering consistent dividend growth, which adds to its appeal as a long-term investment. From 2011 to 2022, SCHD has shown a dividend growth rate of 11.34%, meaning the dividend payment grows 11% every single year. If you invested in this ETF in 2021 and hold till today, you'll find your dividend has skyrocketed from 12 cents a share to an astonishing $2.56 a share. Looking forward, let's assume a more conservative estimate, say a 10% dividend growth rate annually. If that holds true, it means the dividends payout will reach $5.05 a share in 2030. In fact, we would essentially double the dividend payment every 7 years. SCHD has all the qualities you should look for in a dividend ETF. It's a well-diversified fund with companies in all sectors. Industrials, healthcare, financials, consumer defensive, and technology have the biggest share of the fund. They are followed by energy, consumer cyclical, and communication. At the time of this video, its top 10 holdings are Broadcom, Pepsi, Home Depot, Merck, Cisco, Coca-Cola, Texas Instruments, Chevron, Pfizer, and Verizon. These companies are, for the most part, considered bulletproof. They have a strong track record of consistent returning profits back to shareholders through dividend payout. This ETF holds 104 stocks in its portfolio, and the top 10 holding weighs about 41.8% of the entire allocation. Another fantastic aspect of SCHD is its low expense ratio of just 0.06%. For every $10,000 invested in SCHD, you only pay $6 for the fund's management and operating costs. Trust me, that's one of the cheapest expensive ratios you'll find across all ETFs. As investors, the expense ratio can add up over time, especially if you're consistently adding more shares of SCHD to your portfolio. So, the fact that it has such a low expense ratio means it could put more money to work after the fees. It makes holding onto this ETF for the long term even more appealing. All in all, SCHD seems like the perfect ETF to hold through a recession or any other economic climate. Its diversified holdings, consistent dividend payouts and growth, low expense ratio, and historical performance make it a strong contender for investors seeking stability and reliable returns. These are a few reasons why I believe SCHD could be a fantastic buying opportunity before the next economic downturn or recession hits. Of course, it's crucial to remember that we can't predict the exact future of the stock market. However, during a recessionary environment, personally, I'll be looking to invest in high-quality, diversified ETFs with a strong history of paying and increasing their dividends. For me, SCHD aligns perfectly with my risk profile. But I want to hear from you all. Do you think SCHD is a solid safe haven ETF to consider if we experience further downturns in the stock market or even a mild to moderate recession? Share your thoughts below. That wraps up today's video on why investing in SCHD ETF before the recession begins might be a game changer for your portfolio. We hope you found this information helpful and insightful. Remember, always do your own research and consult with a financial advisor before making any investment decisions. Before you go, give it a thumbs up and share it with your fellow investors. And don't forget to subscribe to our channel for more valuable content like this. Thanks for watching and see you next time.